It was another strong day in the United States stock market. In fact, we had the NASDAQ Composite with its 7th straight up session and hitting yet another all-time high on the backs of some positive movements out of Apple and Microsoft and the like. We also saw commodities surging. We saw silver in particular take off. In addition to that, gold had another nice move to yet another all-time high. So some positive movements out there for risk assets. However, keep in mind that tomorrow is the first Friday of the month, and that always comes with the employment report. So there is the possibility that there could be a little bit of a shake-up in the morning, depending upon how the market reacts to that. So we'll keep our eyes open to that, but wanted to check in on all of that, see how it affects our posture here tonight, if at all, and then get into our trade application example, where I am going to focus on a stock that you probably use on a fairly regular basis and has been one of the more popular technology-oriented companies out there. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 6th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZee. I would encourage you to follow me, and I really appreciate it when you guys click like and retweet on these Market Outlook related posts over on Twitter. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address you see embedded in the logo there in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us to give us an overview of the 4 major U.S. equity indices. And as mentioned in the intro, S&P 500 was up 0.64% today, and you can see that's a multi-month high. Now, it's not an all-time high. We're not quite to where we were back in February, but clearly 3-month highs in this case, and a nice steady uptrend continues. The Dow Jones was up 0.68% today, and you can see that that has been a very impressive move. In fact, I pointed this one out on Tuesday as saying I was impressed with the bounce off that rising moving average, and the last 2 days have just been a continuation of that move right there. We are now up and through those prior resistance areas, horizontal resistance that was formed kind of there on the 15th of July and then again on the 22nd of July. So now we're kind of gunning from this prior area in the first week of June on the Dow Jones Industrial Average. The NASDAQ Composite, once again, the superstar of this market, it was up 1% today, so a nice solid win there, in addition to the fact that it's been up 7 straight days, and this is an all-time high. And you can see that label right there will confirm that it's at least a yearly high, but of course most of you are aware it's not just a 52-week high. In this case, it's an all-time high for the NASDAQ Composite, as those technology stocks have continued to be the leadership of this market. We have seen a little bit of slippage there. I've noticed a few of the kind of high-flying growth stocks reporting earnings that have maybe slipped up a little bit. So I'll be curious to see where that takes us. But the good news is kind of the marquee names like your Apples and your Microsofts do continue to kind of roll straight forward. And then the Russell 2000 was the laggard here today. It was down 0.1%, so let's call it flat. However, in doing so, you will notice that it did tick to a new multi-month high. So at this point, the only of these 4 that did not hit a new multi-month high today was the Dow Jones, and it's just a stone's throw away from where it was there in the first week of June. Now, as you can imagine, with such bullish activity here in the markets today, no surprise that we continue with our strongly bullish postures. Remember, when you're looking at this particular chart setup, if the background color of the chart is dark green, as it is in the case of all 4 of those charts here currently, that suggests we have a strongly bullish posture using the market forecast intermediate term line, which is the green line down below on that technical indicator that you can find over on the Thinkorswim platform. And as you can see when you're looking at these charts, especially with the NASDAQ Composite, the last 3 months have been almost purely a bullish time period. There's been a couple of times here and here and here and here where we've had weekly bearish posture, but in each one of those instances where it occurred, you've typically heard David and I mention that you shouldn't get away with that, get carried away with that philosophy, because we were still above a rising moving average. So the path of least resistance continued to be to the upside. But even despite those slight moments here and there with the light pink background, the vast majority of this chart for the full 3-month period was strongly bullish. So if you had just randomly woken up one day, pulled up the chart of the NASDAQ composite, asked yourself if you're bullish or bearish by using that market forecast intermediate term line, the vast majority of the time, 80% of the time in the last 3 months, you would have walked away saying, we have a bullish posture. And that's, of course, what David and I have delivered during our presentations during that time period as well. So for those of you that have continued to ride that trend of the NASDAQ higher, congratulations, you've made a mint. Let's go ahead and take a look at our 3 green arrows posture now. And this will be chart 4D. And here, again, no surprise, with such strong movements in the market. And I did hear earlier today on business television, I think they were saying that at this moment in time during the week, we are in the midst of our strongest week for the stock market since the beginning of June. So this has not just been a typical week, it's been an above average type of a week. Now, again, we've got to be careful. Tomorrow morning could kind of wreck all of our plans. Then again, it could light off to the upside. It could be the fuel to push the S&P 500 to a new all-time high if the jobs report tomorrow is met with enthusiasm. So it could work either way, but as of this moment in time through Thursday, we do have a market that's up around 3% on the week, which is a pretty solid week, all things considered. And of course, that means that there's a better chance than not that we have 3 green arrows, and that is the case. You can see here the S&P 500, 3 green arrows. Dow Jones Industrial Average, 3 green arrows. That was just received yesterday, so it continued today. Yesterday it received the 3 green arrows because of the 3rd and final green arrow on the MACD histogram. And remember, on Tuesday I was saying that in all likelihood on Wednesday we would end up having 3 green arrows on the Dow Jones. Indeed, that happened. And it's not that I have the ability to stare into a crystal ball or anything like that. It was just common sense that we were very, very close on the MACD, and all it would take was just a little bit of a bigger price movement on Wednesday to push that green arrow through on the MACD histogram. So that one continues to hold today, and then we have 3 green arrows on both the NASDAQ and the Russell 2000 as well. So promising sign there. We have strongly bullish postures on all 4 of these charts, and we also have 3 green arrows setups on all 4 of these charts as well. For those of you that are looking to trend trade bullishly, this is a fairly strong environment to do that. Remember, if you're a premium or a plus member of Market Scholars, I'd invite you to join my Monday top-down trend trading class. That is where I teach my students how to trend trade, and we've had really good success in that particular portfolio. In fact, I was calculating how much we were off the lows the other day, and we were up 55% from the lows, which is, it kind of left my jaw hitting the floor there, because you don't typically have those types of returns. But this has been a very strange year, to say the least. So if you're in the right areas of the market, in the right momentum stocks, you've seen some really outstanding gains here in recent months. Let's go ahead and now take a look at our 1040 crossover method, and that will be chart 4C. Now remember, this particular chart here is going to be a weekly candle chart, and it goes back 3 years in length. So this is a longer term view that we're looking at here compared to the other ones that we just looked at a moment ago. And the good news is we are now, at this exact moment in time, bullish crossovers across the board. And this is the first time I've been able to say that in quite some time, because as you can see over here in the lower right hand corner, the Russell 2000, as of this exact moment in time, we do have the orange line, which represents the 10-week moving average, up and over the blue line, which represents the 40-week moving average. So that's known as a golden cross. Now remember, again, because we're using weekly candles here, we use the 1040. If you were to use a daily candle, you might be using the 50-day moving average versus the 200-day moving average. But they're effectively one and the same. And at this exact moment in time, we do have a a golden cross here on the Russell 2000. Now, keep in mind, if there's some sort of a major crash tomorrow, it is possible that that particular crossover might kind of unwind itself. So that is the downside of looking at this before the week is up. But at this point, with 4 out of the 5 days out of the way here so far, it's looking very, very likely that we will close tomorrow with a bullish crossover there. And that would complete this series because, you know, we've had a bullish crossover on the NASDAQ for a long time. That happened way back in May. And then the next one after that was the S&P 500, which had the bullish crossover there the first week of June. And then the Dow Jones Industrial Average did it 3 weeks ago. And then this week, last but not least, is the small cap Russell 2000. So even for those that have longer term postures, this is starting to turn into a bullish market. I know the sentiment is not necessarily supporting that. There's a lot of people that feel that the stock market should not be this high. We actually had a good conversation about that in my question and answer session earlier today for those of you that are premium members, if you want to hear my thoughts on that. So there's a lot of people that feel like the market shouldn't be this high, but the reality is it is. And whether it's because of the Fed printing money or, you know, whatever the excuse may be, the reality is the market is going higher. And therefore, if you have exposure to the stock market, you are better off than had you just been stubborn and sitting in cash this entire time. So hopefully these presentations and the charts that you utilize will have convinced you long ago that we have been in an uptrend for the vast majority of these markets that we do focus on. Let's go ahead and now take a look at some 12 grid analysis, starting with chart 5A, and this will be our asset class 12 grid. So as you're looking at this, you can see that we do have 2 red charts on the board, or dark pink, and that's the US dollar, and that's the 10-year US Treasury yield. And remember, those two oftentimes do work in conjunction with one another. When the US dollar trends lower, oftentimes the Treasury yield is falling at that moment in time as well. Not always, but more times than not it is. So it does make sense that those two are together. At this moment in time, the 10-year Treasury yield is yielding 0.53%. So you're getting about 0.5% return to loan your money to the government for 10 years. Not necessarily a great trade-off there. And that is part of the reason why stocks have done as well as they have, because of the trade-off effect. Not a whole lot of people are willing to commit capital for 10 years that won't grow and will merely give you 0.5% return per year in exchange. And therefore, those that are seeking higher yields, more enticing investment opportunities, are oftentimes going towards the stock market. Now, as you can see, we had strong movements here in stocks today, whether it was the U.S. stock market, the foreign stock markets, and you can see that the EFA foreign stock markets, this would be the developed foreign stocks, they were up 0.11%. The emerging stock markets were up 0.31%. So today was a day where the U.S. markets did outperform the foreign markets. That hasn't been the case quite as often here more recently. Then again, you can see that the U.S. dollar was effectively flat today. So you didn't have the wind in the sails of the foreign stock markets the way that we had recently when the dollar had been falling on those days. Today, the dollar did not fall. It was basically just it was unchanged at that moment. So today was a rare day here more recently where the U.S. market was able to outperform there. You can see, of course, long-term U.S. Treasuries had a pretty decent day with interest rates going lower. Long-term Treasuries typically go higher. They were up about 0.5% today. Here's what I mentioned in the intro. Gold is just having a banner year. It just keeps going and going and going and going. We were up another 1% here today in GLD. Let me right-click and maximize that sell. I mean, this thing has just been an epic move for those of you that have taken advantage of it. And of course, we've had some bullish trades in the gold markets here in these presentations in recent months, so we have benefited from this move. And you can see that in this entire move that we're looking at here, you basically have one red candle. So from this moment in time, July 17th, you have one red candle along the way. I mean, that is incredible. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So you have 14 up days 14 up trading sessions and 1 down trading session in the last, basically, let's call it 3 weeks to a month. That if there's anything that you could call consistent, that would be it. Now, for as much praise as I want to shine upon gold here today, the truth is silver looked even more impressive. So gold was up 1.33% today, but if you type in SLV to get a sense of what silver is doing, take a look at that candle on silver. Holy smokes. We were up 7% on silver today. I mean, it just rocketed higher. And you can see it hasn't been as consistent with the wins over the last 3 weeks as gold has been, because you had actually 3 red candles in a row right there, and you had another red candle right there. So there's been a few more sporadic days where you've seen silver sell off, but the net effect of the total move has been even greater. And remember, that is a fairly common occurrence. For those of you that have followed the metals markets long enough, you'll know that sometimes they call silver the poor man's gold, and it oftentimes is a situation where it's more easily manipulated. It's easier to push around. And what you tend to find is that when gold is in a strong trend, silver prices can go up at an even more rapid rate. Now, the opposite can also be true. So when gold is in a downtrend, silver oftentimes underperforms it pretty dramatically to the downside. But it's kind of like a supercharged version of gold. Silver is a bit different. It does have some industrial uses and different things like that, but it is kind of known as more speculative than gold. And so if gold is bullish, then oftentimes silver can be super bullish, and that is that's where we're at right now. And you can see silver is up 93% in the last 3 months alone. You've almost doubled your money in an entire commodity in just 3 months right there. So really impressive movements out of those precious metals. That has basically continued a theme there for us. Let's go ahead and take a look now at our next 12 grid. And this one we will do the US sectors 12 grid, and this will be our market cap weighted version. And here you can see we've got a clean sweep. All 11 sectors, in addition to the S&P 500 itself, have green background charts. Now, the energy chart is the one that looks the worst. So you can see this chart kind of in the middle rung to the right has that lighter green background color. So what that identifies is that we do have a bullish posture using that intermediate line on the market forecast, but in this case it would be known as a weakly bullish posture, not a strongly bullish posture. All the rest of the sectors have strongly bullish postures. Energy, weakly bullish. But there is some positive news I can share with you today on that front, and that is, as of this moment in time, we do have a green tip to that moving average on energy, and it's been a long time since we've been able to say that. Last time that we were able to say that was back in the middle of June. So, you know, if we are going to see a reversal, it's got to start somewhere. And this is a positive sign that we have been able to get up and through the moving average, and that moving average now has tilted a little bit higher there. But because price is so close to that moving average, that could easily go away as soon as tomorrow. So we've got to be careful with not getting too excited about it. But at least we do have some evidence on the charts that there is an attempt at a reversal there for the oil and gas stocks, whereas most of the other charts just look like they're off to the races, right? We see technology once again erupting higher. We were up 1.4% there on technology. And remember, if we would look at the sector selector over the previous week, we already were having some positive mojo out of technology. Now, this was made last Friday, and I'll make another one tomorrow night. But you can see right here that we went from number 6 to number 2. That's a massive move there for technology last week. And I would assume that it's probably going to retain that strength up there. It might even have enough oomph to get up and through where healthcare was. So we'll keep our eye on that. Also, while we're over here, wanted to say thank you to those of you that took the time to click like for me the last time I did the video there on Tuesday. We got up and over my goal of 100 likes on Twitter. So thank you to those of you that do that day in and day out for us. Remember that these videos are free, but they do take up a lot of David and I's free time as well. And so we need to have an appropriate trade-off there. If we're giving you our time and our thoughts and experiences and trade setups and all that kind of stuff for free, then we're hoping that you guys will be willing to support us on social media. Otherwise, it doesn't really do us any good to do the videos at all. So thank you to those that commit to doing that each and every time there for us. Also, while I'm over here, reminder that tomorrow I've got my options for long-term investors class at 10 a.m. Eastern time, and then David will be teaching his popular technical analysis class at 1 p.m. Tomorrow. And then earlier today, I did post the recording of my Q&A session, and David taught his portfolio management class with ETF. So lots of great content for those of you that are premium and plus members of Market Scholars. And I did notice today that the U.S. foods trade that we did there on Tuesday actually has played out pretty nicely for us as well. In fact, I was noticing that this is a rare time where all of my open market outlook trades actually are positive right now. So we have profits on all of our trades at this moment in time. That's pretty rare, right? When you place a lot of example trades, inevitably you're going to have some losing trades along the way. So fortunately, things have been mostly going in the direction we've wanted to with our trade presentations here for these videos recently. So if you're getting value out of those trade setups and you're enjoying watching them and seeing some of the success with them, again, the one ask we have for you, which is a pretty easy trade-off on your part, is simply click like for us there on Twitter. All right, now that we're back here, I did want to point out communications broke out here today. You'll notice that XLC did close at $60 even here today, and it was up 2.63%. And you can see that that candle was one of the bigger candles on the board for that particular chart, and it easily pushed us up and through any of the prior resistance that we were dealing with before. I'm pointing that out specifically because our trade application example tonight is going to come from the communication space. In fact, it's going to come from one of the largest stocks in the communication space and one that many of you use on a daily basis. So without further ado, let me show you which stock I had in mind. I'm going to come over here to chart 3A, and I'm going to type in GOOG. This is Alphabet. Now, of course, you can also trade GOOGL, depending upon what class you want to get into, whether it's a Class A or Class C shares. I don't really care, to be honest with you. They pretty much trade in unison with one another. But let me kind of explain what I was thinking when I saw this particular chart here. So a couple things stood out to me. First of all, we had a pretty nice day, just all things considered for Google today. It was up 1.8%. You can see the size of that candle there was pretty aggressive, and it was an aggressive enough move higher where it pushed us back above the moving average. So you'll notice that that moving average was yellow here for the last several days because price was below it. But the moving average itself never did go lower. It continued to trend higher. And now with price back up above that rising moving average, that moving average tip has turned from yellow to green, which is a bullish sign for us. Obviously, we have some good near-term bullish posture here as well. That's what that light blue background of the chart signifies there for us. And then in addition to that, we also have a bit of a bullish near-term divergence. And remember, that was the concept I shared with you on Tuesday with that U.S. foods trade as well. A reminder of what that kind of looks like. First of all, you're looking for some major lows in the blue line, some peaks. So you could be looking for troughs if you were doing it the opposite way and looking for bearish near-term divergences. But if you're looking for bullish near-term divergences, you're looking for troughs. So there's trough number one. There's trough number two. Notice that trough number one is on July 24th, and that blue line is just barely in the lower reversal zone at that time. It ended that day at 19.26. Trough number two is right over here on August 4th. There we see it ending just a little bit above the lower reversal zone at 22.13. So trough number two is higher than trough number one. Now, if we were to look at the candles that are associated with those two moments. So back here again on July 24th, this candle right here that I'm circling is our first bogey that I want you to keep your eye on. And then the second one is this one right here on August 4th. So you can see clearly during that time, price went down from here to here. At the same time, the technical indicator went up from here to here. So that is known as a divergence there. So when we see those types of things, we have a variety of ways to handle that. And with our U.S. foods situation, that was a lower price stock, so I didn't have a problem with just doing our example trade of 100 shares. With Google, I was a little bit more nervous doing that, considering this is a $1,500 stock. So buying 100 shares of that is quite the commitment, and some of you might not have account sizes large enough for that, so I want to be cognizant of that as well. So instead of doing just a stock-based trade here today to kind of emphasize this bullish move I saw out of Google today, what we're going to do instead is what's known as a bull put spread. And I believe that's what we have going on with the junior gold miners right now. Yeah, so we sold the 43, bought the 42. So effectively what we're doing with Google would be similar to what we're already doing with the junior gold miners, where we're basically selling one put and then buying another put, which creates a credit. And that basically sets up a level on our chart where we don't want the stock to go below. So it's a flexible trading style that allows you to identify a bullish candidate, but it does not require you to see a massive move higher for you to win that particular trade. So in this particular case, what I'm going to do is I'm going to come out here to the September contracts. Now, again, notice that they've already reported their earnings, so some of you might have been curious about that. So earnings are out of the way. So now for the next, several months, we're going to be trading based off of its own dynamics. It's not going to be influenced by an earnings announcement. So I'm going to come out here to the September monthly contracts that have 43 days left until expiration. I usually select a contract somewhere between 20 and 60 days. So 43 is nicely in the middle of that range there. And I like the monthly contracts when I can help it because they're typically a little bit more liquid. So once I've identified the time period I'm focusing on, I then want to identify the strikes that I want to focus on. And for this, I'm going to be looking at the 1405 strike here in the month of September, and that is the 23 delta in this case. So if I right click on the 1405 put and go to sell vertical, that will then load up our trade down below where you can see I'm selling one contract of the 1405 put in the month of September, and at the same time I'm buying one contract of the 1400 put in September. That creates a credit of $1.25. So this is also known as a credit spread in some circles. Now you'll notice that if I click confirm and send, it will show me on the order confirmation dialog box what my max profit is versus what my max loss is. So one of the nice things about selling a bull put spread is that you do have defined risk. So you know what your worst case scenario is. So if this stock went to zero for some reason, it came out that Google was cooking the books or something and it was it went bankrupt. I don't think that's going to happen, but let's just say that it did for hypothetical sake. Our worst case scenario with this trade is that we would lose $375. But if we think this is actually going to go up, which is what we do, we identified a bounce here today, then this is a way for us to take in $125 right now, and we just need the stock to stay above 1403. So you can see our break-even price right here is 1403.75. So basically, this is a $1,500 stock that you're making a bet that does not fall below $1,400. So you've got about $100 worth of wiggle room there in the next 43 days. So if you can get comfortable with that idea, then you have the opportunity to take in $125. Now, what we also try to teach to our students is to make sure you're getting an acceptable amount of credit. So if we take 125 of credit that we're taking in and divide that by 375 max loss that you see over here, that is a 33% return on our risk. We generally are going to look for those setups that have at least a 30% return on risk. So this does get us up and over that hurdle as well. So I'm going to go ahead and send that in, and we'll see if we can get filled on that first thing in the morning. Thanks so much for joining me here yet again tonight. Remember, I've got my options class in the morning. David's got his technical analysis class. Make sure you're joining us there if you're a premium or a plus member. David will take care of you on this video tomorrow night, and I'll see you all next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.